Back in 2001, Enron reported over $1 billion in profit just months before it went completely bankrupt.
Right, which is just wild to think about.
It really is. And it makes you wonder, how does a company that is legally and publicly profitable just suddenly die?
Well, the answer is usually hidden in the exact metrics that most of us just completely ignore when we look at our financial apps.
Oh, exactly. I mean, have you ever opened up an investing platform and you're just immediately hit with this massive wall of random letters and numbers?
It's overwhelming.
It really feels like a secret code,
Yeah.
Like it's designed to keep you out. But it's actually a dashboard telling you whether a company is thriving or if it's just a billion-dollar illusion that's about to collapse.
Yeah, and that wall of numbers is intimidating by design. Wall Street kind of thrives on complexity. I mean, jargon acts as a gatekeeper.
Yeah, absolutely.
But underneath all those acronyms, the percentages flashing red and green, these metrics are really simply measuring human behavior and business survival. The problem isn't that the concepts are too hard for you to grasp. The problem is that they're usually explained using this native speaker financial dialect that kind of obscures the actual mechanics of what's happening.
Which brings us to the really fascinating source document for today's deep dive. We are looking at a set of notes that were originally designed for ESL, English as a second language learners.
Yeah, this is such a cool approach.
It is, because the goal of these notes was to teach major financial concepts to people who didn't grow up hearing Wall Street jargon. And by stripping away all that loaded terminology, the authors accidentally created this, masterclass in foundational investing.
They completely remove the noise.
Exactly. They removed the noise and left us with the pure mechanics of how businesses actually operate.
It forces you to look at the machinery rather than, the paint job.
Right.
And our mission today is to take 3 of the heaviest financial metrics from these notes, the PE ratio, return on equity, and cash flow, and look at the physical reality of what they represent.
Because, you cannot navigate the market or even really understand how your own employer operates until you understand how to price an asset, how to judge management, and, how to verify if a business is actually breathing. Okay, let's unpack this, because before we look at how a company operates on the inside, we kind of have to figure out what the market thinks it's worth from the outside.
Yeah, every purchase starts with the price tag.
Right, whether you're buying a rental property or shares in some massive tech giant, you look at the price tag. And the first metric here is the PE ratio.
The price-to-earnings ratio. It is arguably the most referenced number in all of finance, and yet it is constantly misinterpreted.
Constantly.
But the fundamental math is pretty straightforward. You take the current price of a single share of stock, and you divide it by the earnings, the profit that single share generated over the last year.
So the question you are really asking the market is, how many dollars do I have to pay you right now to secure $1 of this company's profit? If a stock is trading at a PE of 20, I am handing over $20 today just to get a claim on one single dollar of the company's current earnings.
Right.
On the surface, if we just stop right there, that sounds like a terrible trade.
It does sound terrible, but you have to remember that you aren't just buying that $1 of earnings for this specific year.
Oh, right.
You're buying the rights to that dollar and hopefully, a growing number of dollars for the entire future lifespan of the company.
Okay.
The price part of the PE ratio is driven by market sentiment. It's driven by millions of people predicting the future.
But wait, I have to push back here for a second. If there are millions of Wall Street algorithms and supercomputers scanning these stocks all day long, analyzing every single data point, how can a low PE mean a stock is a bargain?
That's a great question.
Wouldn't the market have already, bought it up and driven the price higher?
Well, that assumes the market is perfectly rational and always looks at the long term.
Which it definitely doesn't.
Exactly, which we know isn't true. The market is largely driven by fear and greed.
Right.
So a company might have a low PE, say, you're only paying $8 for $1 of earnings because the market is terrified.
I see.
Maybe the company is facing a massive lawsuit, or they operate in an industry like oil or manufacturing that's just currently out of favor. The algorithm sees the short-term risk and just drops the price.
A low PE could mean you actually found a genuine bargain because everyone else is just overreacting to bad news.
Yes.
Or it could be what investors call a value trap, right?
Absolutely.
You buy it because it looks cheap, but the company's actually dying. and those earnings are about to disappear entirely.
Yeah, precisely. It's a trap. And then, well, look at the other extreme. What if the PE is incredibly high? What if you're paying $100 for that exact same $1 of current earnings?
I mean, that means the market expects explosive growth. People are willing to overpay today because they really believe that $1 of earnings is going to turn into $20 in a few years.
Right.
But, that introduces a massive hidden danger.
Right? Yeah, it really does.
If you buy a stock with a PE of 100, it's basically priced for absolute perfection.
That is the crucial insight here. When you pay a massive premium, the company has to deliver flawless, continuous growth to justify your price tag.
Yeah.
If a high PE company misses their earnings target by a single penny, the whole illusion shatters. The stock price collapses because that growth premium just vanishes.
Oh, wow.
You see this constantly in the tech sector.
Our source document actually brings this down to a very grounded analogy using coffee, which I loved.
Oh, yeah, the coffee one is great.
Let's say you see a cup of coffee for $2. Now, $2 is a very low absolute price.
Yeah.
But if you take a sip and it tastes like dirty, lukewarm water,
gross.
Yeah, you actually overpaid. It was a terrible deal.
Right, because the absolute number, the $2, tells you literally nothing about the value you actually received.
Exactly. But if you go down the street and pay $5 for this incredibly complex artisan roasted coffee, that higher price tag might actually represent a fantastic deal based on the quality you get.
Yeah.
You can't just say $2 is good and $5 is bad. You have to ask what you are getting for the money.
What's fascinating here is how this completely dismantles the idea of an expensive stock.
How so?
Well, a stock trading at $300 a share with a PE of 15 might actually be significantly cheaper than some penny stock trading at $2 a share with a PE of 400.
Right, because of what you're getting.
Exactly. The PE ratio forces you to evaluate the business, not just the sticker price.
Okay, so that gives us the external view. We evaluate the price tag, we weigh the market's expectations, and, let's say you decide to buy in. You hand over your capital.
You're an owner now.
Right. And the moment you do that, your priorities shift entirely. You need to look under the hood and figure out what the management team is actually doing with your money.
You transition from evaluating the market's opinion to evaluating the internal engine of the company itself.
Which brings us to the second metric, ROE, or return on equity.
Yes, ROE.
The source material defines this heavily around the concept of efficiency. But wait, I have to pause here.
Sure.
Because efficiency is a really loaded word. I mean, when most of us hear about a company becoming more efficient, we imagine the factory floor.
Oh, completely.
We picture employees being timed on their bathroom breaks or assembly lines moving twice as fast to crank out more widgets per hour.
Yeah, we tend to default to operational speed.
Right.
But ROE is entirely disconnected from how fast the workers are moving. It is a measurement of pure financial efficiency.
Financial efficiency.
Yes, it tracks how much profit the company is able to generate, specifically using the shareholders' money, the equity.
And the equity being like the money I gave them when I bought the stock, plus any profits they've kept over the years, right?
Yes, exactly. Your money is their raw material. The management team's sole job is to take that equity and use it to create more value. So ROE is kind of the ultimate scorecard for how capable they are at performing that specific alchemy.
The bakery scenario from our source material perfectly illustrates this, I think.
Oh, that's a brilliant example.
So imagine we're looking at two different businesses, Bakery A and Bakery B. At the end of the year, the income statements for both bakeries show exactly $1,000 in net profit.
And if you only look at the bottom line, which is honestly what most casual investors do,
Guilty as charged.
the two businesses appear to be completely tied. I mean, $1,000 is $1,000.
But then you look at the equity they used to get there. Now, Bakery A is flashy. They secured $10,000 from their shareholders to start.
A lot of capital.
Right. They bought imported Italian ovens. They leased this massive retail space in a premium neighborhood. They bought custom display cases. So it took $10,000 of equity to generate that $1,000 of profit.
Which is a 10% return on the equity provided.
Right. But Bakery B, they only needed $5,000 of shareholder equity to start.
Very lean.
Super lean. They bought refurbished ovens. They negotiated a smaller footprint in a developing neighborhood. They were just incredibly disciplined with the capital. So Bakery B generated the exact same $1,000 in profit, but they did it using half the starting money.
If we connect this to the bigger picture, Bakery B has an ROE of 20% compared to Bakery A's 10%.
Wow, double.
Yeah. And that tells you the management team at Bakery B is vastly superior at allocating capital. They respect the money you gave them. They don't need to throw massive amounts of cash at a problem just to generate a return.
So naturally, as an investor, I want to pour my money into Bakery B. I mean, I want the team that squeezes every drop of value out of a dollar.
Of course.
But let's dig into the mechanics of this, because I really want to know how Bakery B is doing it. Like, are they just smarter, or is there a hidden trap here too?
Oh, there is absolutely a trap.
I knew it.
And it all comes down to leverage, debt. The metric is return on equity, not return on total assets.
Okay, walk us through how that changes the math.
Sure. Let's say Bakery B still needed $10,000 to buy their equipment, just like Bakery A.
Okay.
But instead of asking shareholders for the full $10,000, they only asked for $5,000 in equity. And then they went to the bank and borrowed the other $5,000 as a loan.
So their equity is only $5,000.
Yes. They still make the same profit, and because their equity base is so small, their ROE looks incredibly high.
Right.
The management looks like geniuses on paper, but they achieve that high ROE by taking on massive debt.
Oh, wow.
So if interest rates suddenly spike, or if a recession hits and people just stop buying pastries, Bakery A has no debt to pay. They survive. Bakery B, with its artificially juiced ROE, defaults on the loan and goes bankrupt.
That completely changes how you look at the number.
Completely.
A high ROE could mean brilliant, lean management, or it could mean they're aggressively borrowing money and putting your investment at severe risk.
Yeah.
You really have to check the debt levels before you applaud the efficiency.
It forces you to look at the whole chessboard. I mean, PE tells you what the market expects. ROE tells you how management is operating the machine.
Right.
But neither of those metrics answers the most terrifying question in business.
Okay, here's where it gets really interesting.
Yeah.
Because you can have a stock with a perfectly reasonable PE ratio and a brilliant management team generating fantastic ROE, and that company can still die overnight.
Happens all the time.
Which brings us to the final metric, cash flow, the heartbeat. And this is where people get incredibly tripped up. Because we just assume that if a company is generating a profit, it obviously has cash flowing in.
Right. And this raises an important question that strikes at the core of our entire financial system.
Okay.
Profit and cash flow are not the same thing.
They aren't.
Not at all. In fact, they can exist in entirely different universes. Profit is an accounting calculation. Cash flow is the literal physical movement of money into and out of a bank account.
The source notes use this brilliant scenario with a smartphone. Let's say you have a used phone, and you decide to sell it to a friend for $500.
Okay.
You agree on the price,
Okay.
you shake hands, and you physically give them the
Yep,
phone.
the transaction is complete.
Exactly.
Yeah.
And according to the rules of basic accounting, you just generated revenue. You had an asset, you sold it, and you recorded a profit of $500.
Right.
So on paper, you are suddenly richer. You are a profitable enterprise.
Because you have recognized the revenues since the economic event actually occurred.
And then your friend takes the phone and says, thanks, I'll pay you next year.
Oh, no.
And you agree to the terms.
Yeah.
So now you still have that recorded profit. You have a legally binding receivable.
Yep.
But then you walk down the street to a deli and you want to buy a turkey sandwich. You literally cannot buy that sandwich.
Because the deli does not accept accounting profits as payment,
Exactly.
they require cash.
You are wealthy on paper, but you are broke in reality.
Yeah.
And it just blows my mind that multi-billion-dollar corporations operate under these exact same vulnerabilities.
It happens every single day.
Wow.
And it is the primary reason businesses fail. Which brings us to, honestly, the most powerful quote from our source material.
Let's hear it.
Profit is an opinion, but cash is a fact.
Profit is an opinion. I mean, that feels almost scandalous to say, considering how much the financial media just obsesses over quarterly profit reports.
They do.
So how is profit an opinion?
Because profit is shaped by the rules of accrual accounting. Companies have massive discretion in how they calculate it.
Discretion.
Yeah, so for instance, if a company builds a factory for $10 million, they don't subtract $10 million from their profit this year.
Oh, they don't?
No, they use depreciation. They decide, well, the factory will last 10 years, so we will only subtract $1 million from our profit each year.
So they basically choose how to spread the pain out over time to make the current year look better.
Exactly. And they recognize revenue before the customer actually pays the invoice, just like your smartphone example.
Right.
They shuffle inventory costs around. Two different accountants can look at the exact same business and legally calculate two wildly different profit numbers based on the assumptions they choose to apply.
That's wild.
That is why it is an opinion.
But cash is a fact.
Cash cannot be manipulated by an accounting formula. You log into the corporate bank account, and the money is either there or it isn't.
Yeah.
You either have the actual liquidity to pay your suppliers and make payroll on Friday, or you don't. A company can have a mountain of incoming orders and record-breaking profits on their income statement. But if their customers are taking 90 days to pay their bills and the company runs out of cash on day 30,
They're done.
it is game over.
Game over. Going back to our hook at the very beginning of the deep dive, that is exactly how Enron collapses. They recorded massive profits on future contracts that hadn't actually paid out yet. So they were rich in opinions, but entirely starved of actual cash. And when the bills came due, the heartbeat just stopped.
Cash flow is the ultimate lie detector. I mean, PE and ROE are wonderful tools for measuring value and management skill, but cash flow is the only metric that confirms whether the entity is actually alive.
So we started this deep dive staring at an impenetrable wall of random numbers on a financial app. But by stripping away the native speaker jargon and focusing on the core mechanics, we can actually see the reality of what is happening.
You can see the machine.
Right. First, the PE ratio. It is the price tag, but more importantly, it measures market expectations. Are you buying a cheap stock because it's a bargain, or is it a value trap?
Yeah.
Are you paying a massive premium for a company that will crash if it misses a single target?
Exactly.
Second, return on equity. It measures the financial efficiency of the management team. Are they doing more with less, like Bakery Bee? Or are they artificially boosting their numbers by quietly taking on massive amounts of dangerous debt?
The leverage trap.
Exactly. And finally, cash flow. The heartbeat. The ultimate reality check that proves whether a company can actually survive the winter regardless of what their accountants say their profit is.
It's the most important one.
So what does this all mean for you? You don't have to be a Wall Street trader to use this. Tomorrow, when you are walking down the street, look at your favorite local coffee shop or restaurant.
Just look at how they operate.
Right. Look at the real estate they lease, the equipment they bought, how much inventory just sits idle on the shelves. Ask yourself, is this a high ROE business? Are they maximizing their returns with minimal waste? Or do they overspend on the aesthetic?
It's a great exercise.
When you start viewing the world through the lens of capital efficiency and cash flow, that secret code starts to make sense everywhere you look.
It genuinely reorients your entire perspective on commerce. And, I want to leave you with a final thought to mull over, building directly on the tension between these metrics.
Okay, lay it on us.
We established that profit is an opinion shaped by accounting rules, while cash is an undeniable fact. Consider the dark side of that dynamic.
Oh, the dark side.
If a management team's bonuses are tied to the stock price, could they theoretically use those accounting opinions to manufacture a brilliant high-growth profit margin?
Whoa.
Could they manipulate their debt to create a stellar ROE on paper? I mean, they could build a completely synthetic profile that makes their PE look incredibly attractive to Wall Street algorithms.
While secretly bleeding out of actual cash in the real world.
Exactly.
A perfect illusion right up until the exact moment they file for bankruptcy.
It happens way more often than you would think. So it's a compelling reminder that the next time you open that financial app and look at that flashing wall of numbers, you must look past the shiny ratios and the optimistic opinions. Always, always check the heartbeat of the cash flow before you decide to buy in.